untangling the connection between yield curves, recessions, and stock market performance in this week's fastest 4 minutes in finance. Hello, and thanks for joining us for this week's segment. And this week we are going to do our best to cut through some noise out there about the inverted yield curve and what it could mean for your investments. Well, first of all, what is a yield curve? The simple answer, it's a comparison of two types of fixed incomes of different maturities and the difference between the current yields as measured on a curve. One of the most commonly watched is between the 2-year U.S. Treasury yield and the 10-year U.S. Treasury yield. In a normal interest rate environment, you would expect a higher yield on the 10-year than the 2-year. So if you started with the yield on the 2-year and drew a line out to the 10-year, it would curve upward. An investor would expect to be rewarded for holding a longer-term bond, right? That would be a normal yield curve. But when shorter-term rates are higher than longer-term rates, we get an inverted yield curve. And that's been the case in our current economic environment since July 2022. We've actually gone 533 trading days with an inverted yield curve. That's the most ever. Historically, when the yield curve inverts, it's a good sign that a recession is soon to follow. But it's oftentimes when the yield curve returns to normal first. Take a look at this chart from LPL Financial. You see the yield spread going back to 1979. The dotted black line is even. The red shaded areas are recessions. There are 6 recessions. And look at when that black line drops below even and is negative. The 2 most distant recessions started while the yield curve was inverted. The next 4 didn't start until the yield curve returned to normal. You can see at the far right of the chart that the yield curve is closer to returning to normal now. So does that mean a recession is about to happen? And if it does, what about the stock market? Well, here's another chart from LPL Financial. This one shows the S&P 500 index performance with those green circles representing points in time when the yield curve disinverted or returned to normal after being inverted. Historically, after that happened, the S&P 500 index has been up, on average, 9.8% in the 12 months following. That means that, recession or not, the stock market doesn't necessarily drop after the yield curve returns to normal. The Federal Reserve will meet next month and very likely may begin cutting interest rates, which would logically drive short-term yields down and begin to normalize the yield curve. Bottom line, LPL research points out that while a yield curve returning to normal has often signaled a recession, we need additional context. In the previous recessions, the Fed cut rates to spur economic growth. This time, a possible cut would likely be in response to confidence that inflation is receding. In addition, the disinversion of the yield curve does not necessarily mean the market will take a dive. As historical data shows, the S&P 500 index tends to trade higher after a curve spread crosses back above zero. Thanks for watching.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.